Oil holds its decline with Russian energy curbs in focus. Oil prices were little changed to start the week as traders assessed the impact of new European sanctions on Russian oil supplies. The latest sanctions are aimed at further crimping the Kremlin's energy revenue, the bulk of which comes from oil exports to India and China. Meanwhile, US oil drilling is in the doldrums and crucial trade deals have yet to be reached. Homayoun Falakshahi is senior oil analyst for Kpler. So Russia reacted by saying they've built up a certain immunity to Western sanctions. How effective really are these sanctions?
Indeed, generally speaking, the EU sanctions do not have the same reach as the US OFAC sanctions per se. So I think we could see some impact, but definitely will remain relatively limited, I'd say. But generally speaking, this package is quite tough and quite ambitious compared to some of the previous EU packages. So I think we may see actually a reshuffling of some of those flows, whether that's crude, whether that's refined products. And so indeed it will have an impact. But the fact that you see the market not reacting or showing very little reaction, it's really an indication of what the market perceives those sanctions as being, the fact that they are going to have limited impact.
You mentioned refined products there, and the bloc gets about 15% of its seaborne diesel from India and Turkey. They purchase crude from Russia. Could we see some signs of stress in refined oil products?
Yeah, definitely. Looking at the diesel market, it's been already quite tight over the past few weeks already. Diesel cracks have been outperforming other products cracks. I think the near-term outlook is quite bullish for diesel cracks, especially in the Atlantic Basin. Again, the market reaction has been relatively muted on diesel too. Meaning that the market is kind of confident that in the European Union, you could have alternative supplies coming from the US Gulf Coast, for example, or from the Middle East. I think it's also an indication that the market also believes there are going to be more loopholes, just like we saw for crude when it comes to diesel. For instance, we could see Indian diesel reach, I don't know, for example, the Middle East. And then in turn, we could see more Middle Eastern diesel exports go to Europe. So, the barrels will still be there. It's just that, we're probably going to see a reshuffling of how they actually reach the European Union.
President Trump has threatened to impose stiff economic penalties on Russia. Would we see a larger oil market reaction if he follows through?
I think so, yes. It really depends on whether that's it's going to be secondary sanctions, secondary tariffs. The administration itself is not very, I would say, clear on what it really wants out there. That said, when it comes to both types of sanctions, if it's secondary sanctions, it's obviously much, I would say, stricter, much larger impact because that means that the likes of probably India and Turkey will turn away, will turn their back on Russian crude. China, because there's already secondary sanctions on Iran, sorry, and they have been continuing to import Iranian crude. We may see continuous buying from China, but at the same time, Iranian crude being bought by China is really done by the independent refineries. And that means that the state-owned refineries in China would also turn their back on Russian crude.
US oil drilling rigs dropped for a ninth straight week on Friday. That's the longest streak in 5 years. Why the persistent drop in demand? Is this a serious worry?
I think so. It really shows that, where prices are is really not an incentive for producers to increase drilling activity. We estimate the break-even for new wells in the US shale sector to be around 60-65 WTI. So it's pretty much where we are now. We're slightly above that. But it's not high enough, in short, to incentivize more drilling activity. So when it comes to these producers, they are looking at I would say, the sweetest spots right now. And so they are making more use of drilled but uncompleted wells, which, break even is obviously much lower because some of the cost it's already sunk cost, it's already behind. I would say that this comforts us in the view that US shale output is probably going to peak this year. We actually foresee a drop of 200 kbd next year for US production unless, prices rise. But given where prices are and where we expect them to be, we actually expect prices to decrease by another $15 per barrel in the second half of the year. It means lower activity. You don't. It's not enough basically for, the U.S. administration to ask producers to drill more. You actually need higher prices in order to do this, and we're not seeing that. So it means that U.S. production probably going to start declining in the second half of the year and into next year.
That was Homayoun Falakshahi of Kpler. Don't forget, you can watch more videos on Reuters.com.